Look at the headlines. Gold is breaking records, and everyone is doing the same thing. They chase the yellow metal at the exact moment the crowd finally notices it. But here's the twist. If you're trying to protect your wealth in 2026, the safe trade might already be crowded, and the smarter move might be the metal that behaves like a spring that's been compressed for years. In 2025, gold had a great year, roughly up 65%. But silver didn't have a great year. Silver had a gravity is optional year. Silver surged around 144 to 149% in 2025. And by late January 2026, silver added another jump around 25%, pushing into the $94 to $100 zone. That's not a normal move. That's a squeeze-like move. So the question is simple. If gold is the wealth preserver, why is silver acting like the wealth multiplier? Tonight, I'll break it down in 5 parts. The ratio that decides everything. Why silver moves after gold and then passes it. The supply deficit nobody can patch. Quickly, the physical premium signal, you can't fake the demand engine, solar, EVs, and AI infrastructure. The ratio that decides everything. The gold-silver ratio is the single most underrated indicator in precious metals. It answers one question. How many ounces of silver does it take to buy 1 ounce of gold? In 2024, the average ratio was around 85 to 1. Meaning 85 ounces of silver for 1 ounce of gold. Now look at January 2026. That ratio is crashing toward 50 to 1. When the ratio collapses during a bull market, it usually means one thing. Silver is catching up fast. And historically, when silver catches up, it doesn't tap the brakes politely. It tends to overshoot. Because silver is high beta gold. Gold walks, silver sprints. Gold climbs stairs, silver takes the elevator. Now do a simple thought experiment. If gold stays strong and the ratio compresses further, people throw out targets like 30 to 1 or even 15 to 1 as a historical monetary reference. I'm not telling you those numbers will happen. I'm showing you why the market gets obsessed with them. Because a ratio is leverage disguised as a fraction. Example, if gold is high and the ratio goes from 50 to 30, silver doesn't need new magic. It needs math. That's why silver can move violently even when gold looks calm. So if you're staring at gold and thinking, I missed it, the ratio is basically whispering, maybe you're staring at the wrong chart. Why silver moves after gold? Here's a pattern that shows up again and again in metals bull markets. Gold moves first because it's the cleanest, simplest fear trade. It's the asset that institutions and cautious money recognize instantly. Silver moves second because it needs a spark. It needs momentum. It needs the, okay, this is real moment. And then, once it starts moving, silver can pass gold on a percentage basis because the silver market is smaller, thinner, and more sensitive. Think of it like this. Gold is a cargo ship. It turns slowly, but it doesn't get knocked around as easily. Silver is a speedboat. It can change direction fast, and it can flip fast. That's why the same investor who can calmly hold gold might emotionally struggle with silver. But that volatility is not random. It's a feature of a market where industrial demand competes with investment demand. Inventories are not endless, and small shifts in availability create big price reactions. So when people say silver is too wild, they're accidentally describing why it can outperform in a squeeze. Volatility is the price you pay for potential upside. The key is not to fear it. The key is to manage it. And we're going to talk about how in the checklist at the end. The deficit, 6 years of drawing down. Now let's talk supply. Silver has a problem that gold doesn't. Gold mostly sits. It gets stored, it gets vaulted, it gets held. Silver gets used, consumed, dispersed into tiny amounts, across millions of products, and when it's used that way, it's harder to recycle at scale. A lot of it simply doesn't come back. That matters because 2026 is shaping up as the 6th consecutive year of a global silver deficit, and the estimated 2025 deficit was around 118 million ounces. Think about that. A deficit means demand exceeded supply, not price went up, not people feel bullish. Actual metal demanded exceeded actual metal supplied. And here's the part that most people miss. You cannot fix a physical deficit with a spreadsheet. You can't print ounces, you can't code ounces, you can't optimize ounces into existence. Mines take years to develop. Refining capacity doesn't appear overnight. Scrap flows don't surge just because a chart looks exciting. A multi-year deficit is like a slow leak in a ship, and the ocean doesn't care about your opinions. In practical terms, deficits are paid for by inventory. That means stockpiles get drawn down, and as stockpiles thin, the market becomes more fragile. Fragile markets do not move smoothly. They gap. If there's one signal that gets my attention more than price, it's the physical premium, because price is often discovered in paper markets. Premium is discovered in the real world. In January 2026, a major signal has been flashing. Physical silver in Shanghai has been trading at roughly a $10 per ounce premium over London and New York references. That premium says someone is willing to pay more right now for real metal. And here's why that matters. If physical premiums widen while paper price lags, it can create stress on the deliverable side of the market. In plain English, contracts promise metal. Premiums reveal whether metal is easy to source. A persistent premium is a shortage signal. Not a rumor, not a theory, a signal. Now let's simplify the paper versus physical idea without getting lost. Paper markets are amazing at setting a reference price. They are efficient at trading exposure, but the physical market answers a different question. Can you get the metal in size on time at the advertised price? When the answer is not easily, premiums widen. When premiums widen, arbitrage gets harder. When arbitrage gets harder, the system gets noisy. And in noisy systems, you sometimes get sudden repricing. That's why I call it the smoking gun. It's hard to fake, it's hard to argue with, because it's literally buyers competing for atoms. Into 2026, the market is also dealing with tighter availability through export licensing and supply controls. You don't have to have an opinion about it. You just have to understand what it does mechanically. When a supply artery narrows, the first place you see it is not always the headline price. It shows up in longer lead times, higher premiums, more out-of-stock messages, and more urgency in delivery language. And that urgency spreads, because every industrial buyer has the same fear. If I can't source it later, I need to lock it now. That is how squeezes become self-reinforcing. Now let's talk about the reason this squeeze narrative exists at all. Silver demand is not only investment demand, it's industrial, and the world is building systems that require silver at scale. Let's hit the big three. First, solar. In 2026, global solar capacity is projected around 665 gigawatts, requiring roughly 125 million ounces of silver annually. And unlike jewelry demand, a lot of that silver is not coming back soon. It's embedded into panels, used, dispersed. Second, EVs and electrification. With around 15 million EVs projected for production in 2026 and silver usage per vehicle plus charging infrastructure, the auto sector can consume huge volumes. Numbers vary depending on design and component mix, but the direction is clear. More electrification equals more silver. Third, AI infrastructure and data centers. This one surprises people, so listen closely. AI is not just a software trend. It's a hardware build-out, and hardware build-outs are metals stories. High-performance computing requires reliable switching, high-quality connectors, thermal systems, power delivery, and components designed for low failure rates. Silver shows up where conductivity and reliability matter. Even small per-unit increases become massive when you multiply by millions of units. So silver demand isn't just a store of value story, it's a strategic input story. And when a strategic input runs a deficit, it behaves differently than a luxury item. Let's compare gold and silver in a way that actually helps decision-making. Gold in 2026, lower volatility generally, often steadier, often more controlled. Driven by reserve behavior and risk hedging. Silver in 2026, higher volatility, industrial deficit dynamics, more sensitive to availability shifts, the potential to move in explosive bursts. Here's the simplest table you can remember. Gold, safety first, silver, upside first, gold, calmer, silver, louder, gold, shield, silver, sword. Now let me be very clear. When I say, don't buy gold, buy this instead, I am not saying gold is bad. Gold is legendary for a reason. Gold is insurance, but insurance is not the same as upside, and sometimes the asset that feels safer has less room to surprise you. If gold is the quiet vault in the basement, silver is the crowded hallway where everyone suddenly realizes there aren't enough exits. Myth number one, silver is just a cheaper gold. No, silver is an industrial metal with a monetary shadow. It behaves differently because it's used differently. Myth number two, high price means it can't go higher. That's a psychological trick. Markets don't stop because a number feels big. They stop when buyers stop bidding or when supply suddenly floods in. Myth number three, if the squeeze is real, it should be smooth. Squeezes are not smooth. They are messy. They are emotional. They are driven by positioning, availability, and urgency. Here's what squeeze conditions often look like. Price rises faster than most people expect. Pullbacks get bought aggressively. Premiums widen and stay wide. The ratio compresses as silver outpaces gold. The narrative shifts from investment to availability. It stops being a chart conversation. It becomes a sourcing conversation, and that's why emotional decision-making is dangerous here. Silver moves fast. It can spike 10% in a week and drop 8% in a day. That's the cost of high beta exposure, so you need rules. If you want a disciplined framework, watch these 7 indicators. Gold-silver ratio trend. Not the number in isolation, the direction, the speed, the compression, physical premiums. If premiums stay elevated, it's a supply stress sign. Delivery language. When buyers talk about metal now, it matters. Inventory headlines and visible drawdowns. Not every rumor is real, but persistent drawdown narratives are signals. Industrial demand events that translate to ounces, solar buildouts, electrification projects, data infrastructure spending, volatility behavior. Does silver fall and instantly rebound, or does it fall and stay heavy? That tells you who is in control. Your own risk tolerance. If you can't hold through volatility, don't pretend you can. And here's a bonus rule that saves people. Never let your position size be bigger than your ability to sleep, because the worst investor is not the one who's wrong. It's the one who panics at the wrong time. The biggest mistake people make in fast markets is this. They buy because they're scared of missing out, then they sell because they're scared of losing money. That is the perfect recipe for getting chopped up. So here's a simple approach. If you believe silver has room to run, you decide your plan before the next big candle happens. You decide how much exposure makes sense, how you handle volatility, what signals would change your thesis, and what would make you step back. Planning beats predicting. This is not a gold versus silver culture war. This is a positioning and availability story. Gold can be a stable anchor. Silver can be an amplifier. In 2025, gold was the hedge, silver was the multiplier. And in 2026, the gold-silver ratio collapsing toward 50-1 is the market whispering, the catch-up trade may not be finished. If you want a follow-up video, comment one word below. Ratio. And I'll map out what 51, 31, and 15-1 would imply, using simple scenarios, not hype. If you found this useful, hit like, subscribe, and share it with someone who's only staring at gold and missing the bigger squeeze. Because sometimes the best safe haven is the asset everyone underestimated. Let's make this concrete with a simple scenario map. Not because the future is guaranteed, but because numbers force your brain to stop guessing. Imagine gold is roughly $4,800. That's just a round reference for the math. At a 50-1 ratio, silver is about 96.6. That already lines up with the $94,100 zone we're seeing. Now watch what happens if the ratio compresses further. If the ratio goes to 40.1 with gold at $4,800, silver math says about $120. If the ratio goes to 30.1 with gold at $4,800, silver math says about $160. If the ratio goes to 20.1 with gold at $4,800, silver math says about $240. And if you ever saw a 15.1 style ratio with gold at $4,800, silver math says about $320. Again, I'm not predicting those prints. I'm showing you why people call silver explosive. The ratio is a lever. A small move in the ratio can imply a big move in silver, and the lever works both ways. If gold stalls and silver gets hit, the ratio can expand. That's why silver demands humility. You don't approach a speedboat like it's a cargo ship. Now let's talk about the market plumbing in plain language. Most people experience silver as a number on a screen, but big buyers experience silver as a logistics problem. They care about what form it's in, where it is, how quickly it can move, and what the all-in cost is after premiums and delivery. That's why spot price and real acquisition price can diverge. When physical demand surges, a few things can happen at the same time. Futures trade huge volume, but fewer people want to part with metal. The market offers paper exposure easily, but physical bars take longer to source. Premiums rise because sellers demand compensation for parting with inventory. Arbitrage gets less reliable because timing and financing matter more. In calm markets, those frictions are small. In stressed markets, those frictions get loud. So if you only watch the screen price, you might think, nothing's happening. While the physical market is screaming, it's tighter than it looks. When I say squeeze, I'm not using it as a meme. I mean a real-world situation where demand is persistent, supply is constrained, and the marginal buyer is forced to pay up. A squeeze doesn't require drama, it requires imbalance. If deficits persist and premiums stay elevated, the market can be forced into a repricing event where the reference price jumps to match reality. That jump can be slow and then sudden, because markets often deny reality until they can't. Here's the psychological trap. Gold makes people feel safe. Silver makes people feel uncertain, but uncertainty is sometimes where opportunity lives. In 2025, many people waited for silver to calm down, and while they waited, it ran. Then, when it finally looked confirmed, they chased, and that's why the only real edge is a plan. If you want a simple way to think about metals exposure, here it is. Bucket 1, insurance. That's where gold shines. Bucket 2, upside with risk. That's where silver shines. You can respect both buckets without turning it into a rivalry. The mistake is trying to force one asset to do the other asset's job. Gold's job is stability. Silver's job is leverage to the metal's cycle. If you demand stability from silver, you'll hate it. If you demand explosive upside from gold, you'll be disappointed. Different tools, different jobs. A higher silver price doesn't mean silver is worse value. It can mean the opposite, that the world is finally repricing a metal that is being consumed. The real question is not, is silver expensive? The real question is silver available at scale without paying up? And in January 2026, the premiums and the ratio are telling you availability is the story. If you want a quick routine, here's a simple weekly dashboard. 10 minutes. No doom scrolling. Check the gold-silver ratio. Is it compressing or expanding? Check physical premiums. Are they stable, rising, or snapping higher? Check the tone of the market. Are pullbacks shallow or violent? Check industrial cues, solar, electrification, and data build-out headlines. Check your own emotions. Are you calm or are you impulsive? Because the market doesn't just test your thesis, it tests your temperament. Silver outperformed gold in 2025. Silver is still accelerating into January 2026. The ratio is collapsing from the 80s toward 50. The market is running multi-year deficits. Premiums are the real-time stress gauge, and industrial demand is not a maybe. It's a structural engine. That's the squeeze narrative without drama. Now you decide, do you want the shield, the sword, or a mix? Stay disciplined, stay curious, and don't let a fast chart steal your plan. One more reminder, volatility can be brutal. If you're new, respect position sizing, avoid leverage you don't fully understand, and remember that no asset goes up in a straight line. The goal is not to win a week. The goal is to make smart decisions you can stick with for a full cycle. If you want the next video, comment silver and tell me which metric you watch: ratio, premiums, or industrial demand. Final thought. Gold is what you buy when you want to be left alone. Silver is what you buy when you believe the world is quietly racing into a bottleneck. Energy, data, electrification, and hardware. In a bottleneck, the most useful input gets repriced, not politely, but suddenly. If you can handle the speed, silver is the trade the ratio is begging you to study. Not because it's guaranteed, but because imbalance is visible. Watch the premiums, watch the ratio. Let the market show its hand. Each week, go.